Dividend investing is a great strategy for providing passive income every month. Unfortunately, one of the biggest drawbacks with this strategy is that it usually takes decades to achieve any worthwhile results. And it will for you too, no matter what. Do not listen to anyone who tells you otherwise. I am not here to bullshit you. You have to find a way to make more money than you spend, and then put that money aside for a minimum of 10 to 20 years to see any noteworthy results. And most people won't be able to retire in less than 20 years. But retiring in your 40s is still pretty early and potentially achievable if you have a modest lifestyle. Dividend investing is an investment strategy that involves buying stocks and companies that pay out regular dividends. The appeal of this strategy is that it provides a source of income that is not dependent on the stock market's fluctuations. Instead, dividend investors receive regular payments, typically quarterly but sometimes monthly, based on the company's profitability. This can provide a more stable return, which is particularly attractive for retirement planning if you don't want the stress of a bear market. Warren Buffett is a renowned advocate of dividend investing, although he has highly recommended value investing as well as investing in broad index funds, depending on your level of time commitment. Comment below if you'd like to hear about how to do either of those. So, for those looking to follow in the footsteps of a legendary investor, this is one option. The amount of money you need to invest to live off dividends depends entirely on your lifestyle and spending habits. The most significant driver of this is where you live, but your own personal choices are still an essential factor. As reported by the U.S. Census Bureau, the median household income as of 2023 in the U.S. is roughly $78,000 per year. In a big city, that won't go far. But in a middle of nowhere country town, that very well could make you rich. Now, you may personally need or want more or less. We're going to round to $75,000 for our sample calculations here, but feel free to follow along and redo the math with your own magic number. Now, let's assume that you can get a 5% dividend return. If you don't know how, I've linked below an M1 finance link that goes to a custom-built fund that brings in 4.89%. Take a look at it and make your own amendments before investing. But, based on the assumed 5% dividend rate, that means you need 20 times that amount invested, and that means you need $1.5 million. I know what you're thinking. I don't have $1.5 million. No worries. I also do not have $1.5 million. But compound interest is our friend. So is real estate in some cases. If that strikes your fancy, click the link above to figure out how to do that. In my opinion, real estate is even stronger than dividends. But we're here to cover dividend strategy, so let's press. If you invest $600 per month in a 5% dividend portfolio, reinvest the dividends, and assume a modest stock growth of 2%, you can get there in 40 years. At $1,000 per month, you'd need 33 years. This goes down if your lifestyle is more modest or your discretionary income is higher. Securing a high-paying job can help you accumulate wealth. Who would have figured? Still both very solid, but there are other investment techniques you could use to grow your money before converting it into a dividend portfolio. One debatably risky option is to use covered call ETFs. Covered call ETFs are a type of fund that allows investors to collect income from both stock appreciation and dividend payments. The ETF invests in stocks, but also writes call options on these same stocks for additional income. Call options give the buyer the right, but not the obligation, to buy a stock at a certain price within a specific time frame. Therefore, when the ETF sells call options on stocks in its portfolio, it receives premium income that is paid out to you, the investor, as a dividend. Furthermore, if the stock price rises above the call option strike price, then there may be capital gains that are realized as well because the ETF will be forced to sell those stocks. Some popular covered call ETFs are ticker symbols GILD, XYLD, and RYD. These funds have attractive yields in the double digits, which is way higher than the yields of many traditional dividend stocks, like Warren Buffett's favorite Coca-Cola. The risk of using covered call ETFs is that the options may expire worthless, or the stock's price could decline in value, although that latter risk is the case with most any stock. Since covered call ETFs routinely pull in over a 10% yield if all goes according to plan, you could cut the dollar amount that you need in half. But this also means your risk of failure is higher. Another option is real estate investment trusts or REITs. Many companies pay dividends because they no longer expect to grow. Their market share or profitability is roughly capped. Similarly, you don't earn profits from real estate the same way you do selling commodities in most cases. REITs are of a unique legal status and actually have an obligation to pay a portion of the rents they receive to investors. This makes them very strong dividend investments. Some examples are Blue Rock Residential, Apollo Commercial, and Omega Healthcare. My personal favorite, however, is Realty Income, ticker symbol O. Ticker symbol O, Realty Income pays dividends monthly, so it's easy to watch the number go up and get a dopamine spike every month when you get a dividend. So I strongly recommend this one for someone new to investing. You'll get a rush from watching the dividends pay out so frequently, and this will psychologically encourage you to set more money aside to invest in Realty Income. It will vary REIT to REIT, but the average REIT return for the past 2 decades or so was about 8%, which is a tad lower than the covered call ETFs, and it still brings your magic number or time needed down considerably over the more conservative and one finance pie linked below. Now, not everyone will reach the approximately $750,000 needed, even with these higher return rates. But not everyone has enough disposable income, or you may be starting your investing too late in life to achieve this goal. That is okay. Just having a dividend portfolio that covers 2 of your bills while you draw Social Security in old age is going to be a great boon to you. And if you have kids and you're good to them, I'm sure they'll help take care of you, and you can pass this on to them, almost guaranteeing that they can achieve financial independence in their lifetimes as long as they don't blow it. There are risks with everything. Out of 3 options presented here, the M1 Pie is the safest, but not guaranteed. The covered call ETFs are the most risky, but also potentially the easiest or most beneficial if all goes well. Make your own choices, but living below your means and setting some money aside in any way that it grows is almost certainly going to work out to be a net benefit for you. You only have one life to live. Grow it relentlessly.